recording. All right, cool. Thanks for joining, guys. It's just a simple just market analysis we're gonna just do together. Feel free to speak up if you want. You don't have to. There's no pressure. Just here to kind of share my thoughts and then answer questions, have a discussion if anyone has anything they want to add. So, really quick, before I even get into the charts, I just want to share a pinned post I have on market discussion. So if you go to the Discord and you go to the pinned messages, I have the market seasonality pinned there, and I'm going to move it to the streaming screen so you guys can see. And there we go, zoomed in. This is a market, so S&P 500 index seasonality in a 20-year range ending in 2023, right? So from 2003 to 2023. And this is from Equity Clock, and this basically just shows what the average move of the market is throughout the whole year in general. Doesn't matter if it's election year or post-election year. And this is not like an exact blueprint for how markets move, but it just gives you an idea of what historically tends to happen in a certain time period. Sometimes it's accurate, sometimes it's not. And I'm still learning more about it, of course. I'm young myself, so I haven't been in the markets for like 25 years or anything like that. But what I've noticed is that when the market starts to differ from seasonality, that kind of means something's up, you know. But like July right here is known to be one of the most bullish months of the year historically. And so going into July, I just had that in the back of my mind. I said, like, most likely July is going to be a bullish month. I don't know how bullish, right? Seasonality shows it being basically just straight up the whole month. And coincidentally, I mean, that's what we saw this year. We saw literally July just go straight up. There was barely any dips in July, and if there was, it was quickly bought. So, so I just wanted to kind of just show that and just show what it shows for the rest of the year, right? So August, we see that right when August starts, we start seeing some pullback and some volatility, all right? So August, it's kind of funny, like August 1st, the first day of August, we see like a big pullback, you know? Um, so generally speaking, August to October are considered the weakest months of the year, especially September and October. So going into August, just kind of keep in mind that the markets historically tend to be weaker around this time. So keep that in mind when you're doing your trading and your investing. And then obviously we have the famous Santa Claus rally every year where the market bottoms in October and we just basically rally the rest of the year. Um, so yeah, last year actually in 2024 we didn't have a Santa Claus rally. We kind of just kept chopping up and then pulling back, chopping up, pulling back, chopping up, pulling back. And generally that signals like possible weakness in the beginning of the year. So just on your own time, look at that. Look at 2024 winter, that happened just 8 months ago, and then look at the end of 2021. We also didn't have a good Santa Claus rally end of 2021, and that was right before the 2022 bear market. That's kind of how I use seasonality, just before I even go into the charts. And I'll switch over to the chart now. Cool. All right. So this is SPX, S&P 500 index, and the best way to analyze the market is by analyzing SPY because it acts as a proxy for the rest of the stocks in the market. And I'm going to hide that. And yeah, and we just entered a bearish structure. And the reason why I say that is firstly, when I plot AVWAP-Q, which I talk about it in my videos a lot, it's probably my favorite indicator for determining short-term trend in a very easy, quick way. And basically what it is just, and everything I have is on TradingView for free. So you don't have to like pay for any of these indicators except for my trading signals, which I developed myself. But um, basically, a VWAP queue is just VWAP anchored to the beginning of each quarter on SPY. It works really well on the indexes. It doesn't work that well on individual stocks. Actually, for individual stocks, you can anchor to earnings, and that works really well. But for indexes, because they rebalance every quarter, basically. So when they rebalance every quarter, it kind of sets a good anchor point for a period of time. And it just VWAP is just volume weighted average price. So it plots a line that factors in the price and the volume of each trading day on the daily chart. And generally, when the price is trading above this indicator, it signals a bullish bias in the short term. It means that the market, uh, like buyers are in control of the market. There are more buyers and sellers, and when they see that price coming back down to that line, that is usually a good entry point for institutions to run their algos and buy. Until it's not, until the amount of algo that are buying at that line are overshadowed by the amount of sellers taking profits there. And then when the price closes below, that enters a bearish structure. So there's more sellers and buyers, and this is all short term. I'm talking. So you can see here on July 1st, price tested VWAP, and we saw a wick down here, and the price closed above it. And same here, tested, closed above it. Right here too, tested, closed above it. So, and on TradingView, you can actually plot VWAP historically too, manually. So if I go back, like for example, to January 1st or the January 2nd, and I'll just delete this really quick. Same thing, price closed below. This is bearish. You can start taking some short-term shorts if you really wanted to. Close back above it. It's bullish, 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 bullish until it doesn't, right? And then you can see here, and when the tariffs were starting to get announced and the tariff fears are coming in, you can see like price just constantly trying to test that level up here and just keep failing, and more sellers coming in. So this is a really good indicator. Highly recommend it. And that's the first sign that told me, okay, this is bearish. We closed below it here. The second thing is I have my trading signals. Obviously, I'm not going to explain how I calculate them, but this is a second way that I use to determine like potential trend of the market. So like we plotted a buy signal back in April 24th, and it signaled like a nice uptrend in the medium term, and we got that. Friday we signaled a sell signal, and just to show you historically, it tends to be decently accurate, more than 50% for sure. Probably I would say about 75%. So this was July 2024, sell, August 2024, buy, sell, buy. So, and I know it's like buy and sell. I don't really mean like you buy SPY calls and short the market. It gets kind of like it just symbolizes the upcoming trend. So buy would signal like an upcoming uptrend kind of thing. Um, so yeah, so that's why I think we're entering a bearish structure. Seasonality wise, we're entering a weak period. A VWAP Q, we're closing below, and then a sell signal on that market. Um, any questions so far about that? Is that pretty clear? Or anything anybody like want to add? Cool. So just so now, what you have to be aware of is you're going to see a lot of bad news pouring in on the news market. Happens every time. No one's worried about recession in July when everything is going up, and the moment the market starts selling off, you're going to start seeing headlines talking about recessions and trade wars coming back, all that, whatever they're going to say. And I'm not saying that they're lying or anything like that, and like that information is based off like factual events, but they time it to affect people, right? Like they weren't releasing recession reports that much in July when the market was up. Why are they releasing it when the market starts selling off? You know? So, and that's just to influence people, probably specifically retail traders, to try and sell their positions off to institutions. Um, but I think more is just because like media, that's how they make their money, you know, with like clicks basically and views. And when the market's down, that's when people will pay attention to more bad news. So that's what I think it is. Um, but anyway, just be ready. If like a lot of bad news, try to ignore them on a technical basis. Like this is a really strong uptrend that we're seeing. And I say that by looking at the simple moving averages. I'll just post three of them. So the blue is a 50, the green is a 150, and the pink is a 200 day. And so a really good way to determine long-term uptrends, which I do have like an article on in the channel market manual, is using these three moving averages. Well, really it's the 250 and the 150. And basically how you read them, and this works on individual stocks too, is when the 50 is below the 150 and they're both sloping 10 degrees or more, which you can measure on TradingView with trend angle, that signals a long-term downtrend. And so that means when you start seeing this, you're going to start expecting lower lows until the opposite happens over here. When basically the 50 goes above the 150 and they're both sloping up 10 degrees or more, that signals a long-term uptrend. And it's very important, and it's not just a crossover below. It's they both have to slope downwards or upwards the same way. That's what signals the long-term trend. So when the market broke down here, I was watching this, and this never sloped 10 degrees or more. The 50-day did, but the 150-day never really did. Even if I tried measuring it different ways, it never really crossed 10 degrees. So that kind of told me like, until I see that, I'm going to stay neutral in the long term, and ended up we broke back above all major moving averages, and now they're both continuing to slope up again. And you can add the 200 day on top of that. And 200 days even more simple. It's just when price is trading above it, that's bullish. And then if it's sloping up 10 degrees or more, that's also bullish. And you can see that 200 day is sloping up 10 degrees or more. So I'm sharing that with you because like off the technicals and the fundamentals too. I mean, earnings are continuing. Yeah, granted, it's like mostly tech stocks that earnings are growing. But tech right now is like, I mean, I think the Max 7 is just 33% of the market anyways. So the market has been kind of being held up by these giant tech stocks, but their earnings are continuing to grow. I mean, Microsoft and Meta exploded off their earnings. They were making way more money than anticipated, and that's driving the market higher. I know it's not sustainable. We're probably going to see a recession in the future. Nobody knows when, but as of right now, the technicals are very bullish. So ignore the bad news. I mean, unless something very unexpected happens, like unemployment rises like a whole percent, obviously, but like if it's not something like that, just pay attention to what investments you want to buy. This is a good opportunity to buy dips. It's a good opportunity to sell out of the money puts and get some good premium. Yeah, so don't be scared. That's all I'm trying to say with that. But there is some like truth to the recession fears. I mean, I know we all feel it. We all feel things are really expensive. We all feel like I'm sure you have friends that are having a hard time finding a high paying job. No one can afford a home. Like that's not sustainable, right? Something is gonna give, especially with Trump's tariffs raising prices more and slowing down global trade more. That's just not going to make things better. So I wanted to share a few really reliable um, like valuation indicators for the market. And so the first one is going to be the yield curve, and I think I have it here. This is the 10-month to 3-year yield curve. Sorry, 10-year to 3-month yield curve, and this is posted by the Fed, which is Federal Reserve Bank of St. Louis. They update it every day, and I'm going to change the time period to maximum. And basically, what this graph shows is so before I actually do that, let me just grab the snipping tool out and show you what a yield curve should look like. So the yield curve basically is like you have 3 month, you have 1 year T-bills, 3 year, 10 year, and then 30 year. And well, all that usually the yield curve looks like this. When you buy a short-term bond, your yield is going to be really low, like 1%. When you buy a 10-year bond, the yield is going to be like 4% or something like that, right? So when they plot that yield curve, it's going to look like this. Your percent return versus the length of your bond. And the yield curve inversion happens when the short-term yields, so it's either the short-term yields are elevated, so the 3 month now is worth 4%, or or the longer term yields are reduced. So maybe this stays at 4%, maybe this goes up to 6%, right? And now you have a curve that looks like this, kind of. That's an inverted yield curve. And historically, this has been shown to precede, like, I think, 7 out of 9 recessions. So it's a really powerful indicator. And on this graph, it's represented by this percentage relationship going into negative. So negative means inverted relationship. So I guess it doesn't go past 1982 on this graph here, but before the 1990 recession, the yield curve inverted in 1989 and then re-inverted back. So the important thing about the yield curve too, how you read it, it's not that when the yield curve gets inverted that a recession is going to happen. Actually, it's you have to wait for the inversion and then the reversion back. Once this reversion back happens, that's when the recession happens within, I think it's about a year, 6 months to a year after that point. So same thing here and before the 2000 recession. On inverted, I mean this period of time, it was inverted from 2000, almost a full year, basically. Almost a full year. So June 2000 till December 2000. By the time of January 2001, it was uninverted. So it takes time. But once that uninverted recession happened, same thing in 2008, recession happened, same thing during COVID. And look at this. This is, I think, the longest time the yield curve has been inverted in American history, if I recall correctly. We, our yield curve inverted back in 2022. And it kind of uninverted back in 2024, but it's still kind of chopping around. So this is not a full uninversion yet. We need to see like this kind of thing, this elevation. So I don't know what that means. Like I have no idea if the length of the yield curve like matters for anything, how big a recession is. I don't think it does, but whatever it is, this gives validity to the idea that we could see a recession soon. Maybe a year, 6 months, 2 years. Nobody knows. If everyone knew when a recession would happen, it would never happen, right? So that's one. So the 10-year to 3 month yield curve, very important to know about that. And then the second thing is something called the Shiller PE ratio. So if I just Google that, the Shiller PE ratio, so price to earnings ratio based on average inflation adjusted earnings from the previous 10 years, or also known as a CAPE ratio. So it just takes the S&P 500 PE ratio, and then it's kind of like the exponential moving average. Every 10 years, it adjusts for the previous 10 years with inflation. So if you guys haven't heard of the Buffett indicator is a measure of the GDP with the S&P 500 earnings. And the Buffett indicator has been showing like overvalued levels since like 2010 or something like that, or 2012, whatever it is. But the criticism with the Buffett indicator is that, you know, earnings now are higher because of tech, because you don't have to build giant warehouses necessarily to produce and manufacture products with, materials and everything. Like, for example, Salesforce is just a customer relations management software. Their product is all digital. There's no warehouses or factories putting motherboards together and nothing like that. So that causes really high earnings with really low overhead. That's one example. of why it could be termed as outdated. The second thing too is like a lot of earnings come from more international too. As tech grows, global trade grows. So there's a lot of iPhone sales in other countries like China and Africa and the Middle East and everything in Europe. So the Schiller PE ratio I think is a good way to measure it while also keeping up with times, I guess you could say. And so actually on my own spreadsheet, I did end up plotting the Schiller PE ratio from the 1990s, and then I added standard deviations above it. But even without that, you can just see like we're at the top end of the CAPE ratio levels, right, currently, sitting at 38. If I go to my graph, I believe the average is 27. So the average Schiller PE ratio from 1990 till now is 27, and we're trading at 38, which according to this is over one standard deviation over the average. So based off that metric, you can also say, okay, like we're in the more expensive market, you know. So another reason why markets could correct. Um, so I just wanted to share those two things on a fundamental basis, you know. The really important thing to like keep track of too is going to be unemployment rate because recessions also tend to happen when you see the unemployment rate start spiking. And right now, our unemployment rate has been basically steady for a long time. So by spiking, I mean you'll see like if I launch the chart, something like this. Obviously 2020 was like an anomaly. I understand the pandemic, but here, like in the 2000 financial crisis, 2008, you started seeing unemployment spike 5%. Next month, 5.3%. Next month, 5.6. Next month, 5.8. Next month, 6%. Within 6 months, unemployment rate rose by like a percent. You know, when you start seeing spikes like that, pretty much what if you're not already in a recession, then it's going to start very soon, kind of thing. So, again, TradingView lets you plot this information for free. It's amazing. But definitely keep an eye on that. Yeah, it's trending up a little bit, but again, we want to see those like aggressive spikes in unemployment. So there's some validity to recession. In my personal opinion, I don't think a recession is going to happen. At least, I guess I could say I don't think a bear market in the market will happen until we start seeing earnings cuts and guidance cuts from the mega caps. Because right now they're carrying the market. A lot of other sectors, like healthcare, is a big one that's getting just demolished right now. They're cutting guidance. They're reducing forecast. Like the industrial sector is not doing well. The real estate sector is not doing well. Really, like the only sectors that are doing well is tech. So, and right now they're not cutting guidance. They're like raising it, making more money than ever. So, so I think once we start seeing guidance from the mega caps start getting cut, I think that's probably going to be like a big warning sign. So that's something I'm looking for. But for now, market's bullish. Load up on this dip, in my opinion. I think you should load up. Um, I have my valuation database. Look at the stocks that are in a bullish trend. Look at the stocks that are undervalued. Make note of them. Do your research. See if that's something you want to invest in. Find your stocks that you want to trade. And I think we're going to see a nice leg up uh, probably after October. Um, I guess one more thing I do want to mention, because something I used to do a lot when I was newer, is like the moment I saw a dip, I just go in and buy. And that kind of would burn me in the past. Because if I go to the back to the market, I got burned right here in this dip here. This was July 2023 until basically end of October. This was like a really, I know it doesn't look that bad looking at this here, but this was a very slow burn. This ended up being, I think, a 12% dip over the course of like, yeah, what that, 2 months? No, even more than that. 3 months. Yeah, 3 months. It was so the dip happened here, and I get excited. Okay, yeah, buy. Like I bought here, like heavy, and then the market went lower, and I'm like, okay, well now I don't have cash anymore. Market went even lower. It's like, oh man. So dips tend to happen over a length of time. So try to like not go all in at once. Maybe you start seeing a bottom form, do like a third of your cash here, 25%, market goes back down, make another 25%. That's how I would do it. Like, let's just say, okay, you saw this dip here, you saw the bottoming, you did 25%, and then it continued going up. That's okay. Average up. Institutions average up. You know, if you averaged up here, boom, 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 and maybe here, your average is maybe somewhere around this line. You basically just bought in at the end of this, at the bottom of this August dip. So don't be afraid to average up either. That's totally fine to do. So I think that was a lot of information. So I'm going to pause here too in case anyone wants to add anything or have any questions. I think this is a good time. Yeah, no problem. Glad to hear that. Yeah, no, that's a great question. I mean, it happened with me recently with Novo Nordisk. I mean, I make the same mistakes. Like Novo Nordisk, if you look at the moving averages, 50 crossing below 150, both sloping down. This is in a long-term downtrend. So I was buying in Novo Nordisk in this area here, and I made the mistake of getting really confident when this melt up happened, and I had a full position. But that was my mistake because I should have expected a possible lower bottom, which did end up happening here. So yeah, so that's right. Like just know that as long as this is true, you could always continue seeing lower lows being made until the reverse happens. And I've kind of learned that I'm just kind of more conservative too. Like personally, I do take risks, but I try to be on the more safe side. There's nothing wrong with waiting for the averages to cross up before you invest too. Yeah, like you might miss up on upside. Like if you waited till I would say maybe this point here to invest, yeah, you missed out on this upside, but you're gaining all of this upside too. So that's kind of how I look at them. Okay. Oh yeah. Yeah, yeah. So if you, I think you might have this drop down right next to the intervals. If you do, oh, you don't. Okay. Hmm. That's interesting. Usually, I think for me it was just default. It might be in a setting somewhere, but maybe if you even right click somewhere here, but yeah, basically all you have to do is you find this drop down and you just favorite it. And when you favorite it, it adds it to the bar here. No problem. Got it. Yeah. So actually, this is the signal that I coded myself. So actually, I'm not like giving it out, but I do post them in my Discord. So on the channel market signals for SPY, I will plot when the signal happens. So for example, on Friday, I plotted that we had a sell signal because, you know, I just shared the signals in that channel for you. S- Cool. No problem. So there's no other questions. On the subject of signals, I did start doing the swing signals channel. So I added a new channel in Discord. I think I made a few announcements about it and added an article and market manual with the guide and stats. So basically, every trader's dream, right, is to have like a systematic trading system. And I'm a really big numbers guy. So in my free time, like a big nerd, I'll just like play around with indicators and different coding different indicators if I want to customize how something is analyzed and just using all the different combinations to try and like just make a super high probability system. And I think I was able to do it, you know. It's a little scary, of course, but basically, if you aren't aware, uh, I'm starting in August, so Monday through Thursday, in my Swing Signals channel, I'll be posting anytime I take a swing trade from that system that I developed. Um, and it's a long only system, and it's basically designed because I have a full-time job. You know, I Monday through Friday I can't always be looking at the charts all day. So I kind of designed it around my schedule, and I know a lot of people are in that same boat, right? You have jobs and everything. So I designed it in a way where my signal will come out around 30 minutes before market close, if there's a signal for that day. And you'll go long on that stock. And it's designed typically to be held until the next day, 30 minutes before market close. And I've live traded it with real money over the past 6 months, like through the market drop, and I was able to get an overall profitability, which was really good. I believe every month was profitable. Yeah, like I think like April and March, it was not that profitable, like maybe a percent return or something or less. But I mean, hey, the market was down big time during those months, so you're not losing money. You're actually um, protecting your wealth. Um, but it showed to have pretty good results. And sometimes in that system, when the market's in a bear structure like now, instead of holding the trade until 30 minutes market close the next day, we'll close it 30 minutes after market open the following day. So I'm Pacific Standard Time, so 12:30 p.m. is my 30 minutes before market close. So it would be 12:30 to 12:30 on a typical basis when the market's fine, like in a bullish. But right now in the bear structure, they're going to be from 12:30 p.m. to 7 a.m. And I'll post all that in the swing signals. I'll post ticker, I'll post what I traded, like if I did an options contract or shares, and then I'll also share when my exit time is going to be. So obviously, like, you know, I can't guarantee results or anything like that, but I'm putting like my reputation basically there, and I'm trading it with my money. It's totally up to you if you want to follow it or not. But I did post the stats and they look pretty good. So, and you can risk as much as you want. I mean, you don't have to risk a lot. You know, your risk could be $10. And then if it's I believe that the average gain is a percent. Average loss is about 0.7%. So your spread is 0.3% on average on every trade of a gain. So, you know, you can use as much risk as you want, but this is something I'm excited for, and I think will provide a lot of value to people. Um, so yeah, if anyone had questions on that too, this is if you had anything, you can go ahead and ask. I'm pretty excited about that. Yeah, like on average. So if I average all of my gains and losses, it comes out to about a percent average gain and a 0.7% average loss. Yeah. And I believe it was a 55% win rate. So you have 5% odds in your favor with a 0.3% spread. So it should be profitable over the long term, basically. Um, let's see. I guess when you're using shares, yeah. When you're using shares, I that's interesting actually, yeah, because I've been using $1,000 on my options, and that simulates $10,000 in trading, but I'm not making 30 bucks. Yeah, that's interesting actually. I gotta look at how I presented those numbers actually, because yeah, when you do the math, it doesn't make sense. I was using $1,000 per options, and my total return was 21%, which means it should have been at $2,100. Yeah, in the past 7 months or 6 months. So yeah, yeah. So thanks for bringing that up. Yeah, I'll have to revise how I explain that. Yeah, yeah. If you go to Market Manual, I pinned the swing signals guide. I'll post it up. I'll move it right here. This is a article. So I have the stats and then the guide. Basically, the guide is just how I'm gonna execute it. Oh, thank you, man. I keep forgetting to look at the chat. That's my bad. Oh, um, let's see. The chat, open chat. There we go. Okay. All right. Thank you, Supermon. Yeah. So yeah, I mostly look at the. So he's asking, do you look at different intervals or just always the daily chart? I mostly look at daily chart. Um, but I will look at the 5 minute chart if I kind of want to see, if I want to get a feel for how, like, what the emotions were for that day. Because sometimes, like on a daily chart, like for example, a really good example is this day right here on July 16th, 2025. Um, and if I plot A VWAP Q, right, throughout the, like in the, I think for most of the day, basically the market opened here and was just selling off, and we were like down here, right? So we broke a VFQ and we were trading down there for a while. So I switched to the 5 minute chart to see like how does it look like when we broke a VFQ. Was it like super aggressively, like on high volume? Was there like a lot of volume when it broke? And there was. Like this was a big fat red candle with huge volume, and I was like, okay, like I think this might be the start of the pullback. But then by the end of the day, we just sold back up and closed above it. So that's kind of how I look at the 5 minute chart on the SPY. I don't really use it for anything else on any individual stocks. I feel like the 5 minute chart is more for day trading. But again, like 5 minute chart, you get faster data you can see intraday like what's going on, but there's more noise. This ended up being a bear trap, basically, right? So if you just waited till the end of the day, oops, end of candle close on the day, you would have seen that we ended up closing back above AVFQ. So use at your own risk, but that's kind of what I use a 5 minute for. 30-minute chart, I will use for Wyckoff trades. Wyckoff trading system is another system that I learned. This is from like an OG institutional guy named Richard Wyckoff. And he basically just explained, I mean, he worked in institutions. He was like, hey, this is how we accumulate shares. Is like, think of a bank as like Costco, basically. They buy products for in their warehouse for wholesale prices. And then when they're stocked up, they'll open their doors and sell to retail at retail price and they make that profit, right? When they run out of inventory, so I'll show it to you here on Uber because Uber was a big Wyckoff trade I took. I'm still holding on to. Uh, Close all this. Put the brush on. I have an article too in the market manual that explains the system as well, and I've recommended a book if you want to learn even more about it. But basically, the market moves in uptrend, sideways, and downtrend, or uptrend, sideways, uptrend, downtrend, sideways. It's sideways, and then it's either marking up or marking down. And basically, what that means is just at this point here, institutions have a lot of Uber shares and they're selling to retail, they're marking prices up, and then at this point here, they run out of inventory, right? So now it starts trading sideways. And institutions here are either accumulating more shares for the next uptrend or they're distributing the rest of their shares if they expect the stock to go down. And you have no idea or no way of telling until the breakout happens. There's only one other way you can tell, and it's by something called spring traps, which is like false breakouts and breakdowns. But ultimately, when you see a breakout test and hold, that's like, okay, this was accumulation and the price is now going to start a new uptrend. Sorry, I went really in depth on Wyckoff for some reason. I just got excited. But anyways, I use a 30-minute chart for Wyckoff trades sometimes because the 30-minute chart is quicker moving. Wyckoff trades on the daily chart take like months and months to like play out. But on the 30-minute chart, you can like a week, a few days to a week, and get a good swing trade off. I don't know if I took one recently. I think Broadcom had one a while ago. Broadcom on the 30-minute, yeah, I have it right here. Or was it here? I think it was here. There we go. Yeah, Broadcom had a mini little accumulation pattern on the 30-minute chart here. And so I took a trade when it broke out, tested, and I went long, and then just kind of took profits. I forget where, somewhere here in the first leg up. Hopefully that answers your question. So yeah, mostly daily chart. 30 minutes, I'd use it for swing trading and whack off. 5 minute, I just use it for data, how the day is going playing out. Yeah, good question too. I trade the stocks in my valuation database. I only trade those stocks because they pass my investment criteria. So fundamentally, I know that they're, well, number one, they're liquid. They're large, usually large caps, maybe some mid caps in there, but they're liquid, so easy to trade, easy to get filled on your orders. And then number two, they have good fundamentals. So in the long run, I feel like they're trustworthy companies to trade. hmm I got a question in the chat. How much capital do you plan to use for your swing trades? For me, for my swing, I maybe talking about swing signals. For swing signals, I'm personally risking about $100 per trade. So the way you determine capital is like for someone like me who's kind of like more conservative, I look at how much am I willing to lose on each trade. and I have enough data in my trading history to know like on average how much I lose. So for the swing signals, like I said, average loss about 0.7%. So if you do the math with $100, that means I'm using about 14K capital on shares. Or if you use options, which is kind of like 10 to 1 leverage, I'm using 1400. So I'm planning to use around $1,000 for my swing trades there. And that should get me about, if I'm wrong, an average of $100 loss. Sometimes it could be less, sometimes it's going to be more, but on average it's going to be about $100 loss. And that's how I determine capital. Trading is about survival. Trading like is not about hitting a lot of home runs. It's about not losing a lot. It's kind of like you go into a casino, you're playing blackjack. If you know what you're doing, you'll have like really good odds. It's about like making sure that you stay in the game long enough for the odds to play up in your favor. So that's why I look at how much loss you could have. Or when I sell my options, I always assume like I'm gonna get assigned. So if I get assigned, I need to make sure that it's at a price where I can hold it and not be worried or like I losing sleep at night over it. But that's me. Everyone's different, but that's how I trade. Yeah, so let me look at my sheet here real quick. Um, okay, so I took a trade on Amazon on July 17th with the swings. So I'll go over to Amazon daily chart. Actually, no, I'll pick a loss. That makes more sense. Well, actually, sorry, are you asking me how to go through the math of determining how much loss and how much capital to use, or are you asking how does that work? How do I only lose $100 when I use $1,000? Oh, okay, no problem. So I kind of put it here. So this is an example. So if you're using shares, all right, using the stat of 0.7%, I don't know if you guys can see that. It might be really small. Um, Open in full view. Okay, yeah. So amount you want to risk, divide that by 0.007, and that's total capital allocated per trade. So if I want to risk $100, I'll divide that 100 by that percentage, and that tells me if I want to risk $100 on average per trade, I need to put up about 14,000 in collateral, or $14,000 capital in the trade. And the reason why that only comes out to $100 loss is because let's just say I took a trade on Amazon, and I'm not gonna use a chart. I'm not gonna spend time looking for it. But let's just say Amazon is $100. I took the trade at 100, and then the next day it drops to 98, I guess. That's a $2 loss per share. Let's just say I used, $10,000, $100 a share. I had 100 shares. I closed it at 98. I lost $2 per share at 100, which gives me a loss of 200. I mean, that's not a perfect example, but that's kind of the idea. That's why I lose only 200 because I'm not waiting for Amazon to go to zero. I'm closing it because the trade was unsuccessful. So even though I have $10,000 in Amazon at 100, I closed it at 98. I lost $2 a share. That's a $200 loss. Uh, that's one way to look at it. Sorry, go ahead. Nice. Hmm. Yes. No, I'm glad you're using ATR. That's actually good. I like ATR for stop loss. Um, so for the swing signals, I mean, so overall, I usually don't use stop losses. Actually, I have mental levels in my head, and I use alerts. So I'll set an alert, like if Amazon hits this price, I'll it'll alert me, and then I manually adjust my position based off what I see in the market context. Specifically for my swing signals, I'm also not using a stop loss. I'm doing it just very systematic. It's just you close it at the times that we're planning. Because sometimes what I've noticed is like the next day, like here for example, let's just say I went long on Amazon at the end of the day on June 9th around 216.95, and then the next day Amazon sells off all the way down to 214. If I had a stop loss, it would have been stopped out, but by the end of the day, it was profitable, right? So I don't use stop losses and those signals, and in general, I don't use them. So, um, so sorry if I couldn't answer your question, but that's how I avoid getting stopped out through the normal market movements. But I also have a lot of experience trading, and I'm not the greatest at directional trading either. Directional trading is way harder than option selling because the odds are not in your favor in a way. Unless you're like really good and you can really analyze the markets well and have a really good track record that you feel confident that you're seeing the signs of X movement up or down, it's really hard because you might get stopped out or you might be wrong. But option selling, you're putting the odds in your favor because you're basically saying, I know most likely the stock will not go below this level here. And if whether the market moves down or sideways or up, I'm making money as long as my thesis is right. That's kind of why I don't tend not to use stop losses. Oh yeah, yeah, yeah. Selling puts mostly. No problem. All right, cool, cool. We got a couple minutes left. If anybody has any like other things you want to ask or add, um, and I'll look at my notes to see if there's anything else I want to add too. If not, there was one last thing I just wanted to point out. Um, After the FOMC meeting that we had on Wednesday, um, the odds of a rate cut dropped below 50%. It was like 40%. And I'll show you guys a website. Look at that. It's called CME FedWatch tool by CME Group. They show the probabilities of rate cuts in each meeting, and you can kind of zoom out. Um, and then after Friday, after the jobs report, the job number, the chance of a rate cut skyrocketed up to 80%. So um, this is something good to watch because I feel like people get the wrong idea of rate cuts because of Trump. Um, like where do I start? Like rate cuts are like the idea of a rate cut is to stimulate the economy. That's what it is. And when you stimulate the economy, you have a risk of rising inflation. That's your main risk because money becomes really cheap, basically. And what that means is like when you take out a loan for a car or a house or a business loan or a line of credit to renovate your house, Your interest rate is like 3%, very affordable. A lot of people can make a 3% monthly payment, right? So it stimulates the economy, more people borrow to inject into the economy. When rates are high, it's designed to slow down the economy because inflation is too high. And inflation runs up because prices are elevating, money is being spent more. So when interest rates are high, now all of a sudden your 3% loan is a 7% loan. And that's really expensive. Like mortgages in California, I could speak for California. I'm talking like an $800,000 home, which is below the average, by the way. $800,000 home with a 7% mortgage rate, you're looking at like a 4 grand a month mortgage payment. Just mortgage. That's not utilities or nothing else. That's really expensive versus like a 3% on a $800,000 might be significantly less, maybe like half of that. So, um, so that's what rate cuts are for. Right now, like our inflation is still above 2%. Like it is temporary from the tariffs, but like the tariffs are not even done. Like the trade deals aren't done. They take a long time to be done, so it's hard to predict. And the reason why the FOMC doesn't want to cut rates is because they run the risk of inflation going back up and they lose a big tool they have under their tool belt. What if they cut rates before the economy weakens just to refinance the debt, right? They cut rates and then inflation goes back up and then unemployment rates start spiking. Now they got to cut rates even lower. And now they're going to go back to like what happened maybe during COVID. It's like their rates are at zero. Now they have to raise rates again to correct everything, you know? So like I personally like the FOMC's direction that they're going in. I think they shouldn't, be involved in politics at all. Just go based off straight numbers. Um, but I say all that for context as like why the probability of rate cut went up so much is because of the weakening jobs data. That could be another signal that the market is foreseeing further economic weakness, and the FOMC is going to start cutting rates a little bit preemptively to try and maintain that stable job market. That's kind of just one of the last thing I wanted to kind of share. Because I know there's been a lot of talk of interest rates, and Trump just keeps saying, "Oh, everything's fine," and like egg prices went down, so you can cut rates and we can refinance our debt. But I don't think it's that simple. Yep, it would. Yes. Assuming that economy stays stable, yes. Because there were times in, yeah, like where we are now. Yeah, as long as it stays this way, then yeah, it is bullish. Um, if you look back in 2008, they were cutting rates because the things were already weakening and they were cutting very aggressively. Obviously, that's not bullish because of markets weakening, right? So interest rates in that context didn't do anything to the market. So it matters on the context of the economy. Definitely. Yeah, banks will be, yeah, affected in a nice way because now more people can apply for loans. And that's how they make their money, giving out more loans. So yeah, cool, cool. Yeah, no problem. Yeah, good questions, guys. Um, it's been an hour. I don't know. I think an hour is a good place to stop. But if there's no more questions, maybe I'll give like one last chance for any other comments or questions. Okay. If not, I really appreciate you guys joining. This is really fun. Like I love talking about market stuff, so I'm glad like we're forming a nice community about it and we're all kind of like interacting. So thanks for joining, taking your time out of your Sunday morning for this. Um, I'm glad you guys found value in it. And yeah, I'll try to keep it going every now and then. Whenever we all have time, we can keep doing this. But yeah, good luck in the next few months. Um, stay focused. Don't let these news media scare you out of anything. And keep an eye on the economic data. And yeah, good luck, everybody. Thanks again.